Hello and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks, the last edition of Citrus Bites for 2025. So normally this would be full of events, a review of the year, what happened, all the great stories. Actually, the thing is, there is so much to talk about of what's happened since the budget a few weeks ago. I'm not going to do the review. I'm actually going to talk about what is going on right now. And it feels really timely because we've just had the announcement from the Bank of England Monetary Committee that Bank of England base rate has gone down again from 4% to 3.75%. It's actually, I think, the lowest for about 3 years now. However, although this had been widely predicted by the experts, the vote was really close. So if you've listened to Bites before, there's a number of members of the committee, they place a vote. It only squeezed through on a 5-4 basis. And you may go, well, actually, how come that's such a close vote when I'm hearing kind of quite a lot of negativity about the UK economy? Well, simply it's inflation. So if we go back and I show you the graph, our core CPI, so the green line here is the closest on the graph you can see. Our core CPI is still quite well ahead of the Bank of England goal, which is around about 2%. Having said that, the most recent figure to the end of November showed prices going up, core CPI going up at 3.2%, which is down and also lower than the forecast. So actually, that's a really piece of good news for the government and core CPIs, that sticky CPI we really want to try and get out of the economy. Not included in core necessarily, but the good news is for those of you that are really sweet tooth, it was kind of sweets and biscuits and things that saw one of the most material drops in relative prices. So there's your good news in the run up to Christmas for those of you looking to fill your trolleys with lots of nice sweets and biscuits on the run up. So that's a bit of CPI, core CPI. But remember, it's still outside of the Bank of England commitment to get it down to 2%. So the view is if you drop inflation too much, if you drop the interest rates too much on the back of the inflation cooling, will it actually fuel more spending that causes inflation to go back up when we're trying to strip inflation out of the economy? And that is most likely why the vote ended up being a lot closer than expected. The good news from the graph, though, is if you're looking at all of the lines on there, pretty much they're all heading downwards. So from an inflation perspective, that's a good news story. However, there's always a flip side to this. So let's look at kind of what some of the other DARs are telling us and start with GDP. Again, this is kind of the total value of goods and services within the economy. This slide allows for inflation as well, because you want to know actually stripping inflation out, are we really growing as kind of UK PLC or not? And just looking at the bars and go to the right hand side of the graph, and you'll see that actually we are barely growing in the UK and we need growth. Growth is good. And that growth has really slowed now quarter after quarter. And in fact, I think the most recent month, we actually achieved negative 0.1% GDP in the UK. So negative growth is not a good indicator into the state of the economy. And that was one of the reasons why so many have gone, actually, we're much more likely to see a bank base rate reduction than we did, of course, see today. And for those now, just to pull back to sort of some of the things I talk about very, very regularly and have done all through the year now on Citrus Bites, let's just see how those DARs are looking, because this is where the story is playing out as well. First one being unemployment. And I think I've said for many, many quarters now, there's a view, obviously, unemployment, if people are in work, they have an income, they have money to spend, that's a really good sign in terms of spending capability. As unemployment goes up, that spending capability drops clearly, very difficult for those people who find themselves out of work. But it has a wider knock-on effect because typically as you get stickier unemployment, that leads to more welfare claims. And there's been a lot of noise about the welfare situation recently, and less tax revenue for the government. So finding this sweet spot for unemployment is really tricky. But this has been going up now pretty consistently for the last couple of years. And as you can see now, we're getting back to probably at 5.1%, something that might be seen as a bit of an average. Unfortunately, it's definitely skewed within it. So sort of 16 to 24-year-olds really suffering at the moment to that entry level of the employment market. Hence some of the more recent announcements in the budget, trying to look at apprenticeships and how to drive opportunities forward for particularly for the young age group. So that's unemployment. Again, that means more people that won't have that disposable income available to spend. So something else that I've talked about a lot on Citrus Bites over the last few months and quarters is UK job vacancies. So you can see from the graph here the huge spike we experienced coming out of COVID. Lots of spending going on. People have been, trapped at home, started spending the money. Unemployment was low, so lots of disposable income available. So that vacancy number actually hit over 1 million. So lots of firms who were struggling to fill those vacancies, that then in turn started to drive wage inflation, where in order to attract great talent, employers had to pay higher wages to try and attract the people to plug those gaps. So now the UK job vacancy situation, probably not surprisingly, a number of reasons I come on to, but with unemployment creeping up, slightly less pressure, employers are becoming nervous. Do I make a hire? Do I not make a hire? Or talk about reasons for that in a second, but that's had a real knock-on effect on the number of vacancies. So this has been consistently going down now since the spike after COVID. 636,000 vacancies in the most recent month. I think probably there's more issues behind the data. So those vacancies, a lot of them will be really quite hardcore vacancies in terms of specific professions, specific locations. So actually there are still hotspots for sure within the economy where people cannot hire, and they just can't find the skill sets they're looking for. But the number of opportunities is certainly coming down in terms of the number of vacancies. And moving on, that's had a real knock-on impact in terms of average weekly earnings. And I've talked about this quite a lot. There's been some disparity between public sector and private sector and these big wage increases that have been seen. Having said that now, and this allows for inflation. So what we're looking at really is what's the real level of wage increase? Because if your wage increase is really mirroring inflation, then net it kind of leaves you pretty even. You don't actually have any more money because it's been eaten up by price rises. And we can see now that that is running really close to zero, i.e., wage increases are pretty much keeping level with inflation, but not much more than that on the whole. So that pressure on employers is coming off. Why? Will probably be A, because inflation's going down. So typically they may not be as generous with pay rises, but B, if there's, if they feel like there's less opportunities, they're potentially therefore faced with less wage increases, needing to attract and retain great people. So that's not surprising that we're seeing that. And I think one really big word I would use here is confidence. So there was so much noise coming up to the budget in November, and it went on for such a long time. What we actually saw, both in terms of the employment market and the housing market, is lots of things just really started to slow down. Employers were really nervous about hiring. What am I going to see in terms of changes that are announced in the budget? They're still experiencing, as employers, the knock-on impact of employers' NI being increased in the most recent budget. There's Angela Rayner's kind of HR changes, the employment bill that's still due to land potentially. And that's making employers really nervous about hiring new talent. And you see, therefore, that knocks onto the unemployment, it knocks onto the total number of vacancies, it knocks into the average weekly earnings. But that confidence piece has been really eroded by so much of what's gone on for the last few months. And actually, not just employers and businesses that potentially are concerned about what the next year is going to be looking like. Households are also seeing the same thing. And therefore, if you look at my final slide for today, this is actual savings ratio. And I don't want you to worry too much about the numbers. The graph tells a story. You can see a really big spike. That was the COVID spike. Obviously, a big problem when you can't spend anything, it's easier to save it. So you saw a really big spike in the actual savings per household during COVID. And as we came out of COVID, that savings level really dropped. Could have been for a number of reasons: people traveling, people spending, the freedom again, would have been potentially some really big reasons. But also, this coincided, as you remember, with a big spike going on interest rates, mortgage payments increased. So therefore, the ability for households to save really eased off. Now we're seeing that go up again, and actually quite materially over the last few months. So households are feeling the need to save. And the big dilemma there is how much of that is because they're worried about their jobs over the next 3 to 6 months. And therefore they feel having a cushion, trying to create a cushion. And again, this will be definitely within the data. There'll be lots of variances within households, but you can see the trend. This is going up, which would indicate Confidence levels are running a little low over how that employment market is going to run moving forward. So households are preparing. The flip side again is, that's not great for the government potentially, although it's really good that people do try and prepare themselves. Obviously, spending money does equal kind of the economy growth. So we want to be careful. And that's always the story with this data. At what point does it become a problem? I would say at the moment, most of it is quite balanced. Not great for sure if you're one of the people that's actually been made redundant. If you're now unemployed, trying to find work, there's less jobs available. Actually, but some of the other data is much more near kind of normal averages, if you like. I think what happens over the next 3 to 6 months, whether we can start to see more growth in GDP, and whether the base rate reduction today does that give employers the confidence to go out there. Cost to borrow money for businesses will have gone down most likely as a result of the Bank of England base rate reduction. Do they have the confidence to try and invest and to grow now and to create more opportunities? Do borrowers feel the benefit? And it's typically a question we get asked. I've got a mortgage, base rate's gone down. Do I, will that come into my payment straight away? Or perhaps even more so, I've actually got a mortgage offered. I've not moved in yet. What's going to happen next? Can I renegotiate my rate, etc.? As always, the same message. Please speak to your mortgage broker if you have any questions around what it means for your mortgage payment. So I think lots to look forward to in terms of 2026. It's quite finely balanced. That explains a bit more, hopefully, about why we did end up seeing that 5 to 4 really close call today. Nonetheless, 3.75 has gone down, but as I say, about the lowest base rate for 3 years. Lots to do for 2026. I'll look forward to talking to you as we head through in the beginning of 2026 as to what we're seeing play out following today's announcements. So that's it for this year. I really hope you've enjoyed viewing some of Citrus Bites. Thank you so much for watching, and I look forward to carrying on with the story as we go through 2026. In the meantime, have a great end to the year, have a safe and healthy festive period, and I look forward to seeing you next year. Thanks very much indeed, and bye for now.